All right, let's just dive right into this, because I want to start with a scenario that I think is incredibly relatable for pretty much all of us. You finally do the responsible thing, right? You start saving your money. Every single month, you diligently move a little bit over into your savings account. $100 here, maybe 200 there, and you feel good about it. You're genuinely proud of yourself. The financially mature era has finally arrived. You are doing exactly what the experts say you should do to build a secure future. But then, reality hits.
You open your banking app one day and you realize you've accumulated a really solid $10,000. Amazing. But then you look a little closer at the interest rate. It's sitting there earning what, maybe 0.5% interest? And here's the truly painful reality of that math. That 0.5% means that after a full year, 12 entire months of strict financial discipline, you made a grand total of $50. $50. That barely buys a decent takeout dinner for two. Meanwhile, everyone around you is talking about stocks, index funds, and explosive compound growth, and suddenly you're sitting there asking yourself, wait, am I doing this completely wrong? Well, the short answer is not wrong exactly, but incomplete. And that is exactly what we're breaking down in today's explainer.
So here is our exact roadmap for getting you from just saving to actually investing. 1. The math of missing out. 2. Compounding magic. 3. The 5-step path. 4. Crashing upwards. And finally, 5. Planting seeds. Let's get right into it. Section 1. The math of missing out. Why saving isn't enough. We often think the real wealth gap in society is between people who recklessly spend all their money and people who diligently save it. But that's actually a massive misconception. The true wealth gap is between people who save and people who invest. Let's look at that same $10,000. If you leave it in a standard savings account earning 1% interest, which honestly is on the higher end for standard accounts right now, after 1 year you have $10,100. Okay, that's fine. But let's compare that to investing in the S&P 500, which is basically a basket of the 500 biggest companies in America. Historically, over long periods, that has returned an average of about 10% per year. At 10%, your $10,000 becomes $11,000 in year 1. A $900 difference might seem manageable, right? But fast forward 20 years. In savings at 1%, you end up with about $12,200. But invested at 10%, you end up with $67,000. And remember, that is from the exact same starting amount with absolutely zero extra contributions. Section 2. Compounding magic. Making your money work. Most people stay in savings because it emotionally feels safe. The number just sits there, it doesn't suddenly drop on a random Tuesday, and we really like that comfort. But clinging to that comfort means you're missing out on the mathematical engine of wealth, which is compounding. Compounding is simply when your investment returns start earning their own returns. Your money makes money, and then that new money goes out and makes even more money. It is quite literally growth on top of growth. It's the underlying engine that actually builds long-term wealth, doing the heavy lifting for you while you're asleep. Let's look at another example to really hammer this home. Let's say you invest just $300 a month into the market. Assuming an average 8% return per year, after 25 years, you would have roughly $285,000. But here's the absolutely incredible part of that math. You only actually contributed $90,000 of your own money over those 2.5 decades. So where did the other $195,000 come from? That came purely from investment growth, from compounding. Your growth outpaced your actual contributions by more than double. That right there, that is the aha moment. Section 3. The 5-step path from saver to investor. So how do we actually do this without totally panicking? Well, here are the 5 non-negotiable steps to successfully transition from saving to investing. It's really about building a foundation, shifting your mindset, starting without pressure, ignoring all the noise, and playing the long game.
Step 1 is absolutely 100% non-negotiable. You have to build a real emergency fund before you invest a single dollar. We're talking about 3 to 6 months of your living expenses sitting in cash in a savings account. This money does not move. It is not for jumping on a hot stock tip you heard about. It exists for one purpose only: unexpected emergencies. A job loss, a medical bill, a broken down car. Why is this step 1? Because if you don't have this cash buffer, the very moment life happens, you'll be forced to pull your investments out early to cover the bill. And usually, that happens at the exact worst time, like when markets might be down. Your cash emergency fund protects your investments from the unexpected emergencies of your own life.
Okay, step 2 requires a massive mindset shift. You need to mentally separate your money into 2 distinct buckets. Bucket 1 is your safety money. This is that emergency fund. It doesn't fluctuate, it just sits there, and it is boring by design. Bucket 2 is your growth money. This is your investment portfolio. Because you have your safety bucket totally secured, your growth bucket is fully allowed to go up and down. Its entire job is to grow over a long time horizon. Separating these totally eliminates the anxiety of checking your balances every day, because you've already accepted that growth money will fluctuate. That's a feature, not a bug. Step 3. Start small. A major myth holding so many people back is the belief that you need thousands of dollars to even start investing. You really don't. Most platforms today let you start with 50 or 100 bucks. The goal at the beginning isn't to get massive financial returns. It is just building the habit. Consistency is what actually matters here. The habit of investing automatically every single month is infinitely more powerful than sitting on the sidelines trying to perfectly time the market.
Step 4. Keep it simple. Beginners often make the incredibly costly mistake of jumping straight into day trading or options or crypto speculation, but the simplest strategy tends to beat the complicated ones over the long run. In fact, most actively managed funds actually underperform the overall market over a 20-year period. That's exactly why Warren Buffett, who's arguably the greatest investor of all time, recommends simple, broad market, low-cost index funds for the average investor. You don't need to pick the winning needle in the haystack, you just buy the whole haystack. Keep your fees low and let time do the heavy lifting. Which brings us to step 5. Stay disciplined. You have to let that compounding work over decades uninterrupted.
Section 4. Crashing upwards. What about market crashes? Even with those steps clearly laid out, there is still one massive psychological barrier standing in the way for most people, and it's this. What happens to my money if the market crashes? Look, it is a completely valid fear. Market crashes are normal and they've happened dozens of times. 2001, 2008, 2020, these are massive drops with globally terrifying headlines. It is deeply, deeply unsettling to watch your portfolio value drop. But we need to offer a completely contrarian reframing of these events. The key insight that most people completely miss is that long-term investors actually benefit from market downturns. When the market drops, your consistent monthly investments, the habit we talked about in step 3, they actually buy more shares at lower prices. It's exactly like your favorite store having a massive clearance sale. You don't stop shopping there, you buy more because it's cheaper. When the market eventually recovers, which historically it always has, you are now holding significantly more shares, and those shares are now worth more. The news media pushes fear because, well, fear drives clicks. But the patient long-term investor, they see a crash as an opportunity. Section 5. Planting seeds, the ultimate analogy. To wrap all of this up, let's pull these concepts together into a beautifully simple visual metaphor that really summarizes the entire philosophy of this explainer. I want you to think of saving money like storing seeds in a glass jar on your shelf. They are safe, they are protected, nothing bad can happen to them. But nothing grows either, they just sit there. Investing, on the other hand, is like taking those seeds and planting them in the soil. At first, it looks messy. You don't see any immediate progress. There are bad days, the weather is totally unpredictable, and it can feel really risky. But over time, things start to grow, and eventually you cultivate something that is vastly bigger than the original seeds you planted. Saving gives you stability, but investing gives you freedom. And combining both of them as early as possible, that is where real financial transformation happens. Which brings us to our final point today. I want you to take a hard look at your own financial habits right now. Are you currently just safely storing your seeds in a jar, earning a painful $50 a year? Or are you finally ready to follow the 5-step path, separate your buckets, start small, and plant those seeds in the soil? The math of compounding is waiting for you, but you have to be willing to put the seeds in the ground first. Let that thought guide your next financial move. Thanks for joining me on this explainer, and I will catch you in the next one.